Now we're going to turn to the U.S. as a whole and really kind of dig into some of the U.S. data. Obviously, we talked about it in the previous segment, but now we want to get in a little bit deeper in terms of some of the things that are going to impact us as we go through the remainder of the year. And before we get there, obviously, we'd like to remind you, please like us, share it, subscribe. Your support is a huge appreciation, and we thank you for it. So here's just a quick backdrop of the U.S. trade balance. Again, we're bouncing off the lows, as you can see with 2008, as things started to recover. The question is going to be, where are our trade partners? And the trade partners continue to struggle, specifically in Europe, in Asia, and that's not something that is going to go away anytime soon. And the fact that our imports will remain above our exports is going to keep us in negative territory, which if you just look at where we've been in the past, that's a place we're used to because we are an importing nation. But just given the level of decline in exports and then the level of imports, we're going to remain at a fairly depressed level. And again, it'll continue to recover just because, as we showed in the previous segment, our inventories have been rebuilt, to a certain degree. And when we look at inventories, you have to appreciate, well, you might say, well, inventory is that some of the wholesalers are still down or the retailers, but you have to think of, well, did the imports come in as a finished good and semi-finished good and hasn't been deployed yet? So there is that timing delay, which is why we look at intermodal trucking to see where is it in the supply chain. So this is something that will continue to get a little bit better, but not because exports are increasing, but more imports decreasing. So when we look at total unemployment benefits, it continues to move in the right direction, but it, again, remains elevated just given on a week-over-week level, as we have a total amount of people receiving some sort of benefits at about 21.5 million. So again, it just remains elevated, and as we look at the remainder of the year, we already know that there's new furloughs, there's going to be a new wave of people losing their jobs, unfortunately, as we go through the remainder of the year, as people kind of reset, close out 2020 and then redeploy as we head into 2021. And not only is it just that side of the equation, but it's also the increase in COVID cases. And this is really where we're looking at in terms of employees working, hours worked, businesses open. It continues to shift lower. Again, this is a little bit delayed and it's only accelerated to the downside as we go through October. And this, again, comes to kind of where when we were talking about, look, we're seeing some headwinds. And you might say, like, Mark, you were getting concerned in October again, where it didn't come through the numbers. And this is kind of highlighting where we did get a little bit of an increase. We had a little bit of a bounce. And then as we got through the remainder of October, we peaked and started to roll back over. And it's really been kind of factored into where things have gone as we're looking at, the rise in cases. And again, the rise in cases doesn't mean governments have to lock down. It just means the consumer is going to adjust. You have a certain amount of people that may not be necessary because stores aren't as crowded. And we're seeing some of those slowdowns continue to bleed through the system as they get a little bit worse. And this continues as just based on what we're seeing, especially with some of the employment and some of those underlying figures, that they're going to continue to get worse as we go through the month of November, with hours work going down, businesses starting to close down as they say, look, without more stimulus, without more help, we have no choice but to shutter our doors. Now, when we look at the U.S. manufacturers' new orders, you can see that clearly we had a big spike. They came down and starting to normalize. So September factory orders, 1.1% versus an estimate of 1%. And if you just look at orders ex transportation, 0.5% versus an estimate of 0.6%. So final durable goods orders unchanged. There's not much there. So it's more along the lines of things normalized through September. As we talked about, there was a nice little increase in the first half, let's call it October 1st to the 15th. So this is something that there'll be some support for October, but then they'll start to slow down as we go through the remainder of October and then as we're in November now. So the September factory orders is something that was a nice little beat on estimates, but we think it's going to continue to bleed to the downside, especially as inventories have normalized, all the things that we've said before. This is, again, kind of coming into those numbers where we see, especially the new orders excluding transportation, starting to come down. And I don't know if anybody's been watching Ford, GM, they've had some great Q3 numbers. The problem is Q3 numbers are they're gone, they happened, they're great. It's just Q4 is where we're starting to see some of those headwinds. And as we talk about in the EIA show, and we're always looking at rail data, we're seeing some of those slowdowns really start to get apparent in parts, in pieces, and that goes through the last week of October. And in something that we think is just going to continue as we go through November. So here's just looking at, again, October ISM Services. Again, looking at services versus manufacturing. So October ISM Services came in at 56.6. It's the weakest since May, but it was also below estimates of 57.5. So even though we're still in expansionary territory, again, like nothing to sneeze at in terms of seeing the expansion, it's just... it was supposed to be stronger, and we're starting to see those declines where we're capping and we're starting to slow. And again, it comes to that slowdown in purchases. And when in I believe it was segment 1 or segment 2, we did the breakdown between consumer spending on durable goods versus services, and those services has gotten better, but has really started to slow and level off, and that's what we're seeing here. Now, new export orders, import inventories are all up and expanding. Employment fell, but still barely, again, in that expansionary territory. So when we look at the report on business employment, it had a nice peak and then again pulling back. That's the concern, is that pullback. And if we look at hours worked, and then if we look at COVID cases increasing throughout the U.S., that's something that we think is going to be a continuous headwind as we go through the remainder of November. And this is just important when we think about the manufacturing PMI in a bit more depth when we start breaking down on the contributions, because inventories was obviously a headwind. We had employment as a headwind, but now in October we had a net positive pretty much across the board. Now, this is something that is going to start to slow when we look at new orders expanded, which is a positive, supplier deliveries expanded, which is a positive, but we're starting to see some of that rollback more on the employment side and more on the production side, as we had the new orders come through, but then we had the inventories increase, so you're going to have some of that normalizing. Again, still going to be an expansionary, still going to be positive, but we're just going to be a little bit lower as we go through the remainder of November. And this is really something to look at when we consider about the labor statistics, because the Q3 non-farm productivity was a bit softer than expected. And so, and the problem is it's despite a strong GDP report. So it was up 4.9% versus an expected 5.6%. So there's something to be said about kind of where those statistics lie, which is why we did have a pickup in some of the other areas when we're considering the different backdrops of, what made up that GDP number. And then when we look at the unit of labor cost, it fell sharply by 8.9% versus 8.5%. So it fell sharply. It was a negative 8.9% versus a positive 8.5% in the previous quarter. Compensation per hour fell 4.4% versus an increase of 20%. And it's important to appreciate the dynamics behind that, because when you look at the dynamics, it's because people who clearly everybody went into lockdown, they then had to go out and hire back, and you're rushing to hire people back as you reopen. You're going to reopen them because they were furloughed. You're going to bring them back at the same salary. They may pick up overtime to restock shelves to get things back in order. So those are positives. Those were positive contributions. But now that we're getting back into a slowdown, that kind of dragging economic growth, that's where we're starting to see people who may be unemployed now for 3 months, 4 months saying, hey, I'll take 10% less, I'll take 20% less. And that's starting to come through the numbers when we start looking at that compensation, where now that everyone's been refilled, everyone's back from furlough, well, we have to hire someone new, but let's see if we can get it a little bit cheaper. And that's what you're starting to see kind of fill through the system, which is why when we look at activity, which the Fed's going to talk about, but this isn't only just happening in the U.S. And I just want to drop one chart from Europe, because the ECB is going to be boosting some of that additional PEPP, and they're looking to add about another 500 billion euros, and it's again trying to drive that support. as we go into by the end of 2021, because they're seeing another issue when you're looking at employment through the remainder of the year, and as that bleeds into 2021, which is why they're really increasing that. So in a survey, economists are expecting about 1.35 trillion euro a pandemic bond buying, which is about $1.6 trillion, just to give apples to apples. And that's but then that's boosting it by about 500 billion. And they also expect it to extend by 6 months. So instead of it going from this year into the middle of next year, it's now going to go through the remainder of next year, just because there's obviously the fear of that double dip now that people are back in lockdowns, and they're going to look to help support. So you can see that just the inherent expansion on the trillions of levels that we're going to see with the ECB. So it's not unlikely as we go into Fed Day that we're going to see the Fed do something similar, and we're going to see a continued dovish stance. Now, even though that this is just kind of, again, trying to highlight the fact that the U.S. and Europe are in a similar stance, and we should expect something similar in the U.S., we also have to look at, shifting back now to the U.S. construction. Total private residential versus non-residential. Clearly, residential remains strong because homes, new permits, new construction. Non-residential remains slow and continues to slow. Excuse me. Again, just based on looking at what's happened in the market. So we have a shortage of homes just because you've had people who either can't get evicted, the eviction moratorium. You have a shortage of supply. So clearly people are looking to take advantage of that and building more homes. But when you look at non-residential, you have a wave of bankruptcies. You have a ton of commercial real estate that is being grossly underutilized. So you're going to pare back because the expectation is, and again, anecdotal versus not, people that I speak to that are decision makers are saying that they're looking to shrink their commercial footprint once this is all normalized. They think that they're going to be able to shrink it 20 to 40%, depending on the flexible schedules, people now going more permanent at home, which is just going to, again, put additional capacity in the market, which is going to reduce the total non-residential spending because there's just spare capacity that you can get deals on. So why build something new when somebody can go out and just get a benefit on rent and something that's already standing? So then when we do the bigger drop of where do things sit on the contributions to GDP, this is where we talk about the consumer spending on services. So clearly we had that recovery, but it wasn't the same. Which is why we're still negative, coming back to why, when you look at the line chart on consumer spending, it's still below zero, and it's still slow, but spending on goods, private inventories, again, those were the biggest drivers. So you can see just the sheer size on why that we had that GDP growth in Q3, but it still isn't enough to outweigh the pain that we saw in Q1 and Q2. So Q4 is going to be very important to see just how weak things are, and just given the rising, again, COVID cases and all those other things, not to beat a dead horse at this point, but those are things that are going to continue to weigh on what Q4 looks like. And now, how do we adjust that? How do we drive it higher? And you can obviously come to, what does fiscal aid look like? So this, again, we've shown this chart before, something very similar. The question is now, what happens going forward as we have some additional expirations on things that are currently in Congress now? And then how quickly can we get this turned around given the some of the issues that we have during the current election? So here, other income, compensation continues to go lower, as we talked about with the weakness in salaries. Unemployment benefits continue to whittle down, and people are going to the longer term support. Again, those are things that are going to become an overarching issue as we head into holiday spending season. So this chart is moving in the wrong direction if you consider about, the fiscal aid, which it'll expand back out. The question is when, and then depending on when it happens is going to impact how much that is going to drive either Q4 GDP or Q1 GDP, and it's going to be something to watch overall. But when we look at credit and that house buying and what has really been driving it, again, the boom has been top tier credit, and we talked about this really when we've looked at who can get the loan, who can get the because we did see an increase in requirements to get loans, and this is really why, which is why people with 720 plus are the ones that were seeing the expansion. That will slow now, because now those people who have the credit don't need the credit right now. They've already gotten it. So that's going to be mortgages. And the question is going to be what happens next. And we have an increase in bad debt expense. We have it across the board, which is also going to make banks a bit more gun shy when they go to actually lending some of that new capital out, which is why they have an increase in collateral requirements. And it's just getting harder and harder to get those loans, because the quality of people seeking those loans is deteriorating, because a lot of that top tier is now gone. And now they have to figure out ways to make that work. And when we think about the evictions, because it's something that is going to be very important when we look at the eviction moratorium ending, the likelihood it'll get extended, but the question is always going to be for how long, because it can't be permanent. And this gives you kind of that backdrop of who's going to be impacted the most. And this is why we talk about that additional supply coming on, because you do have the residential building, you do have an increase in residential permits, which means that there will be even more building. At the same time, you're going to see new short sales, which is going to put additional supply into the market and put inherent pressure on that. Now, when we think about lending and we think about homes, we also have to consider what is happening with credit and lending. And this is what we were talking about when we consider people that are searching for new credit. Now, those who have strong credit have already utilized it. They've already gotten their credit that they were looking for. So now you have a slowdown in terms of new people looking for credit, which is moving in that wrong direction. And clearly you can see that obviously it peaked in March and it continues to trend lower. The Eurozone spiked again. It's one that's going to roll back. But this is something where it continues to trend to the downside. And again, you're going to search for it prior to going to the bank, because what are you going to do? You're going to compare internet rates. You're going to see what is being promoted, and then you're going to go to try to negotiate. People just aren't searching as much, and this has been a very good leading indicator for kind of where things are going to go over the next few months, which is, again, why we see lending going down, why we see banks slowing in terms of the money they're willing to put to work. This is going to be one of those bigger overhangs. Now, just to reiterate before we close out the talk on movements, this is what we discussed in the EIA, and I just wanted to reiterate the difference between cars versus trucks. Now, trucks, again, consuming freight and diesel continues to be robust, and it remains fairly flat to let's say up 8%. The problem is gasoline has rolled over a little bit. Now it's down about 15%. The trucking side will remain strong. This is something that we're looking at when we're considering inventories. And the trucking side will remain positive, even though we think that there's going to be headwinds on the rail side. But again, this is something that we cover when we go through the EIA on a weekly basis. And just looking at, because when you might say, well, why even talk about trucking miles right now? And it's because we want to look at credit and debit card spending, because retail is online. So when we look at online, you have to consider, well, what has to be moved? What has to be rejuvenated in here? Home improvement, retail, restaurants has gone negative again. When we look at seated versus takeout remains robust, but seated is slowing. So the retail side, the home improvement side, those are things that are going to see some pressure as we go through the remainder of the year, just seasonal. But again, that's also going to put some weight on that trucking number, which is why we do have some of that confidence that we think intermodal rail will slow versus trucking, because trucking is just more flexible. Retail online is strong. So if you're thinking about strong online, you have to get it from point A to point B. Then you have to get it from that area to the actual home. Again, putting more trucks on the road, keeping them busy, which is why we think that those trucking numbers will be supported through the remainder of the year, because that's going to be the mode of transport. And some of that spending data really does support that, which is why we like to talk about it and look at what that is the bright spot for diesel demand as we go through the remainder of the year.